All right, while we mosey, my son came up with a great idea that I should talk about the no money down, same as cash offers. And I thought that that was a brilliant idea. If you're not super familiar, hopefully you've seen some of the ads out and about where they talk about no payments, no interest for 12 months, same as cash kind of things, right? Usually it's on furniture, cars, building materials, a wide variety of stuff, okay? But what you might not understand is that this is really a deferred interest offer, and it's marketed typically to people with subprime credit. So poor or fair credit ratings, okay? Now, what's the catch, you might ask? Okay, it seems kind of dumb. Credit card companies, banks, and lending institutions, they're all in business to make money, right? So how exactly do they make money off of these offers? Well, remember what I've told you multiple times. They are gamblers, okay? All banks, all lending institutions are gamblers. They're gambling on whether or not you'll pay back your whatever money that you've borrowed from them. Okay. Now, in this particular case, they're actually betting on you to fail in a fashion. Okay. You see, if you pay off those 12-month same as cash offers within the 12 months, well, then essentially you win. Okay. You've gotten whatever it was, the car, the sofa, the TV, whatever it was, you got it without having to pay interest on it, okay? But more often than not, like I said, since they're marketed towards people that have a low or very poor credit score, they are counting on the fact that you probably won't be able to pay it back in time, okay? So, if you get a $1,000 TV, for instance, okay, no payment, no interest for 12 months, it should include somewhere in the paperwork in the application that there is still an interest rate associated with that. And you might think, okay, well, that seems dumb. It says no interest. Why is it telling me an interest rate? Because if you don't pay that back in the 12 months, then you will be charged interest. A lot of times around 25-30%. Remember, it's towards people with poor credit scores, so higher interest because higher risk to the lender. But wait, there's more. Not only are they charging you that, but they're banking on the fact that during that period of time, especially if you don't have to make payments, that you'll forget about it, okay? And so then, if you haven't read the fine print, you wouldn't realize that not only will you owe interest on whatever you have actually paid back. For instance, in this case, with the TV example, let's say you paid $600 over the 12 months. You were paying $50 a month, hoping for tax return, stimulus money, whatever the hell, so that you could pay it off in one fell swoop. But it didn't happen, and so, bam. You're still $400 short. Oh, well, no big deal. I'm only going to pay 25% on the $400, right? No, my friend, that is not how it works. If you bothered to read your fine print in that agreement when you filled out the application, you would have found that not only are you paying interest on the $400 that you do indeed still owe, but you're going to pay interest on the full amount from the date it originated. What? That doesn't seem fair. That's not right. How can they do that? Well, it's in the fine print. Whatever's in the contract that you sign is what you're obligated to, and that's how they can do that. They count on people not reading it. They count on people not understanding what it's all about. They count on the fact that you probably won't be able to pay it back. That's why there's no payments. They're hoping you'll forget. And then they can hit you for the entire amount. And, okay, well, fine. And then if you don't pay back, in a lot of cases, whatever it was can be repossessed, and they can still sue you for the full amount that you owe. You might recall that I'm not a big fan of car loans, and that's because there's a lot of these type of car loans out there that offer low down payment, no down payment, Your check is your credit, these kind of things. Do they sound familiar? And more people than you would think actually fall for this kind of stuff. Okay? Now, because it's marketed to subprime people, I've covered the fact that you will be charged, some cases, a higher interest rate on the $600 that you've already paid. Yeah, that can really get you steamed. You may have a high payment after the period is up, after the 12 months or whatever has expired. Your payment might be extremely high. And if they do repossess your stuff, well, technically they could probably resell it and, like I said, still sue you for the amount that you owe. The only way to beat these schemes is to actually pay them off within the time allotted. And the best way to be able to do that is to be prepared when you purchase the item to pay it off or be nearly in a position. If you, say, are buying a $1,000 TV and take advantage of it 12 months, no payment, no interest, same as cash kind of thing. Well, if you've got $700 saved up, you're only a few $100s short. Odds are pretty high that you might be able to manage the other $300 within that 12-month period. Okay? That really is the only way to win. That's where an emergency fund comes in. That's where educating yourself as to the things that go into your credit come in, and working to have a higher credit score. Because with a higher credit score, you could in fact qualify for a credit card that has 0% interest for a certain period of time. And this is better. If you were to charge it on a credit card that said 0% interest for, say, 12 months, okay, and then we're not able to pay it all off, well, then you would only be paying interest on the portion that you weren't able to pay off within that 0% interest period. I hope this doesn't confuse you. I hope it in fact helps you. If you do have any questions, please hit me at fustyandfinance@gmail.com. Of course, as always, you can message me here on Twitch and Xbox, or you can leave a comment below the video if you're watching it on YouTube.